More and more Aussie parents are stepping in to help their kids buy property. But if you're receiving the age pension or planning to apply one day, it's crucial to make sure you're not accidentally putting your pension at risk. In my last video, I explained Centrelink's gifting and deprivation rules, and we look at the age pension implications of letting your child live at home rent-free, covering their expenses, gifting, loaning money, forgiving the loan, and acting as a guarantor. Welcome to part 2, where I'll take you through the age pension impact of other forms of support, like selling property below market value to your child, gifting property by transferring the title, buying a home with your child, and gifting them rental income. If you haven't watched part 1 yet, I highly recommend starting there, or at least checking out the section on gifting and deprivation rules, so you have a solid foundation for how Centrelink views these arrangements. Let's start with what happens when you sell your property to your kids for less than market value. Let's say you own a property worth $800,000, but you sell it to your child for just $500,000. Centrelink will treat the $300,000 difference as a gift from you to your child. Under Centrelink's gifting and deprivation rules, any amount you gift above the $10,000 annual gifting free area is treated as a deprived asset. So in this case, the excess $290,000 will be counted as part of your assessable assets and be treated as a financial asset under the deeming rules. Meaning Centrelink will assume it earns income, and that deemed income will count towards your assessable income. This applies for 5 years from the date of settlement. Some parents choose to gift a property by simply transferring the title. This is a more extreme case than selling below market value. The parents aren't just accepting less, they are getting nothing at all. Similarly, gifting and deprivation rule applies. In this case, the market value of the property minus the $10,000 annual gifting free area is considered a deprived asset, which will be added back to your total assessable assets and deemed to earn income for 5 years from the date of settlement. Whether you gift a property to your children or sell it to them below market value, there are other important considerations to keep in mind. Number 1 is the timing of the settlement. If the property was transferred more than 5 years before you apply for the age pension, the gifting assessment period has already expired, so it won't affect your age pension. This highlights just how important it is to plan ahead if you want to help your family without putting your future pension at risk. Number 2 is capital gains tax consideration. If you sell, transfer, or gift property to family or friends for less than it is worth, you will be treated as if you received the market value of the property for capital gains tax purposes. This is called the market value substitution rule. If the property was your main residence, you can claim the main resident exemption from CGT. If it is an investment property, you'll have to pay capital gains tax on the profits as if you had sold it for full market value, even if you receive less or nothing at all. The third consideration is the transfer duty or stamp duty as it used to be known. This is payable by your child. As with CGT, the current market value of the property is used to determine how much transfer duty is levied. It's generally a good idea to have the property professionally valued to confirm its market value to show that you haven't underpriced it to dodge capital gains tax or transfer duty. The fourth thing to consider is how giving away such a large asset could impact your own financial security. Helping your children is a generous act, but it shouldn't come at the cost of undermining your own retirement. Finally, think about asset protection. When you gift a property to your child, it becomes theirs, and if their relationship later breaks down, their partner could be entitled to half the property. That means half your gift could end up with their ex-partner. Hey, if you're getting value from this video so far, please take a moment to like and subscribe. It really helps the channel out more than you might think. I really appreciate the support. Thanks, Hips! Another common scenario is when a parent buys a property with a child, either as joint tenants or tenants in common, but their financial contribution to the purchase is more than what's reflected on the title. For example, Sue, age 67, buys a $1 million house with her daughter Mary as tenants in common. Sue is listed as owning 40% on the title, but she actually contributes $500,000, half the purchase price. The $100,000 Sue paid above her ownership share is treated as a gift. If she hasn't used her $10,000 annual gifting free area, $90,000 will be treated as a deprived asset, which will be added back to Sue's total accessible assets and deemed to earn income for 5 years from the date of the settlement. Even when the title matches the actual financial contribution, jointly owning a property with a child is something that should be carefully thought through. A well-meaning decision today could have serious consequences later, especially if you're planning to receive age pension as part of your retirement income. Let's look at an example. A couple, both age 55, wanted to help their daughter buy her first home. To help her qualify for a home loan, they agreed to buy a 50% share in a $500,000 property. By becoming co-owners and adding their financial backing to the loan and title, their daughter was able to secure the financing she needed. Fast forward 12 years, the home is now worth $1 million and the mortgage has been fully paid off. The couple reached age pension age. With $700,000 in savings and superannuation, they believe they will qualify for a part age pension. But they overlook one key detail. Their share in their daughter's home is still counted as accessible asset. That extra $500,000 pushes them over the age pension asset tax cutoff, meaning they are not eligible for any pension at all. So what are their options? If they transfer their ownership share to their daughter now, they face two issues. One, capital gains tax. The property has increased in value. After the 50% CGT discount, they realize a capital gain of $125,000, potentially owing tens of thousands in tax. Second, Centrelink gifting and deprivation rules apply to the $500,000 for 5 years, delaying their age pension eligibility. Altogether, the cost of capital gains tax and lost pension payments over 5 years could well exceed $100,000. If they had known this earlier, they might have chosen differently. They could have acted as loan guarantors, possibly putting up their own home as part security, which wouldn't have affected their future pension. Or they could have transferred their share to their daughter at least 5 years before applying for the pension. While they would still pay capital gains tax, the 5-year gifting period would have expired by the time they applied. This example highlights why it's important to think through both the immediate and long-term impacts of a financial decision. If you're unsure, seeking professional advice can make all the difference. So far, we've been talking about gifting and deprived assets, but there is another form of gifting that often gets overlooked. Gifting an income right. Take Frank for example. He receives an age pension and owns an investment property. Instead of collecting the rent himself, he instructs the tenant to pay it directly to his adult son. Frank sees this as a way to help his son cover rent for a separate property while also reducing his own accessible income for age pension purposes. But Centrelink sees it differently. This arrangement falls squarely under deprived income. Even though Frank no longer receives a rent, Centrelink will still assess it as part of his income, as if he never gave it away. It will count towards his age pension income test. Now, if Frank had simply let his son live in the property rent-free, there would be no income assessed under the income test because no rent is being received or redirected. I have done a dedicated video on how investment properties affect both the assets and income test for age pension assessment. Check it out if you're interested. If you have made it this far, you are clearly serious about helping your children the smart way. That's why you need to watch my video on superannuation death benefit tax. Most people don't realize if you leave your super to your adult children after you are gone, they could lose up to 32% of it to tax. In that video, I share strategies to reduce or even eliminate this hidden inheritance tax, so more of your money goes to your children, not the ATO. Make sure to check it out. Thanks for watching. I'll see you in another one.